During the 2024 campaign, President Trump made a clear pledge to seniors: the complete elimination of federal income taxes on Social Security benefits. Millions of Americans built their retirement expectations around that statement. But when the final version of the One Big Beautiful Bill reached the president's desk, the reality changed. Senate Budget Reconciliation Rules, the parliamentary process used to pass the legislation, legally prevented direct changes to the Social Security tax formula. To see exactly how this affects your money, grab your estimated 2026 retirement income numbers, your projected Social Security benefit amount, and a pen and paper. We are going to build your defensive plan right now. Tax results vary by individual circumstances, and political headlines often omit the fine print. This calculation is designed to reveal the specifics of your own exposure, so you can adjust your strategy accordingly. Step 1 is establishing your baseline. The Internal Revenue Service determines your Social Security tax exposure using a single, highly specific metric called combined income. This equation has 3 precise parts: your adjusted gross income, plus your non-taxable interest, plus exactly 50% of your annual Social Security benefits. Let's run a sample retiree through the math. We take $30,000 in adjusted gross income, add $0 in non-taxable interest, and add $12,000, which is half of their $24,000 total Social Security benefit. That leaves us with a combined income of $42,000. Watch out for a common error here. Many retirees accidentally use their entire Social Security payout in this formula. Strictly having the benefit is required to get an accurate read. Write down your exact combined income number. You must have this prerequisite figure locked in before we can apply any tax defense strategies. Now we test your number against the federal tax thresholds. These specific income brackets were set in 1983 and 1993, and they have been frozen in place ever since. This diagram maps out the single filer limits. If your combined income is under $25,000, you owe zero tax on your benefits. Between $25,000 and $34,000, up to 50% of your benefits are taxable. Anything above $34,000 means up to 85% of your benefits are included as taxable income. For married couples filing jointly, those boundaries are slightly wider. You pay zero tax under $32,000. The 50% exposure tier runs from $32,000 up to $44,000, and the 85% exposure hits everything above $44,000. Take the combined income number you just calculated and find exactly where it lands on this scale to see your initial vulnerability. Because these limits were never indexed for inflation, ordinary middle-class retirees are often dragged into the maximum 85% taxable bracket by default. The legislative relief signed into law to combat this is a temporary $6,000 senior deduction, valid from 2025 through 2028. To qualify, you must be over the age of 65, and your modified adjusted gross income must be less than $75,000 as a single filer, or under $150,000 for a married couple. This chart shows exactly how the deduction works in practice. It directly lowers your adjusted gross income by removing a $6,000 block from the calculation. For a married couple, that becomes a $12,000 block. Because your adjusted gross income is the first part of the formula we calculated earlier, lowering it drops your final combined income total, potentially sliding you into a lower tax tier. However, if your income exceeds those specific eligibility caps, this deduction phases out. High-income earners receive zero tax relief from this provision. For middle-income households, verifying that this deduction is applied correctly is an essential part of your 2026 tax strategy. You also need to protect your annual cost of living adjustment. Social Security benefits increased by 2.8% for 2026, giving the average single retiree an extra $56 a month. But standard Medicare Part B premiums instantly absorbed $17 of that gain. The real risk is a surcharge known as IRMAA. Triggering this surcharge causes baseline Medicare Part B costs to triple, reaching over $600 per month. This timeline illustrates Medicare's 2-year look-back rule. An income spike from an asset sale or a large account withdrawal at age 63 will trigger those IRMAA penalties at age 65. Failing to account for these income events can neutralize the financial benefits gained from the new senior deduction. Now look at the vulnerabilities you've mapped out on your paper. You can select from several defensive maneuvers based on your situation. First, consider executing strategic Roth conversions during your lower income years. Moving money out of traditional accounts early prevents future required minimum distributions from inflating your tax bracket later in life. This chart demonstrates the second strategy, precise IRA withdrawal sequencing. By actively managing the size of the cash you pull from your traditional retirement accounts, you can build your combined income while stopping exactly below your specific danger threshold. Third, time your asset sales carefully. Delaying major liquidations or account withdrawals until you are past the 2-year Medicare look-back window can help you avoid triggering an IRMAA surcharge. Passive planning leaves your retirement income vulnerable to thresholds set decades ago. Proactively managing these specific income levels is a primary defense against federal taxation on your benefits. By running the math today, you have bypassed the political noise. You now possess a mathematical map of your true 2026 tax exposure. Take your physical calculation sheet to a licensed CPA. They need to verify your math and ensure that the temporary $6,000 senior deduction is properly factored into your filing. Do not assume that commercial tax software will automatically catch this newly passed deduction. Manual verification is required to ensure you don't overpay. Build your retirement plan around the law as it is written, not as it was promised on the campaign trail. If this breakdown gave you clarity on your 2026 tax exposure, hit the like button to help this information reach more Americans. Subscribe to SenseWise for new updates and drop a comment below. Did you know the 1993 tax thresholds were still active? See you in the next one.